either way, we're not giving marriage advice. But the point is, most cases with self-employed people, I mean, I'd have to see the math. And so I don't want to say anything absolute. And we're not talking about anybody's individual situation here, but it's a good question. In many cases, it doesn't make sense to pay a bunch of taxes for a spouse that's going to get a benefit just because they're married to you. Welcome back to the Zacc Call Money Education channel. This is episode 2 within Social Security planning. So last time we gave you a rundown as to what the whole season will look like. This episode is 9 essential truths about how your wages shape Social Security. It's important that you understand all 9. Don't give up on us. Get to number 9 because that's where a lot of the strategy comes into place. But you need 1 through 8 to be able to understand that strategy that I'm talking about. If you are self-employed, you actually have a lot of control and a lot of pain around exactly what we're talking about today. So there's an opportunity for you to think about how you strategically choose to pay yourself. If you are not self-employed, if you're a worker and you're thinking about retirement and you're holding on just for Social Security, there are a few things at the end here that may change your opinion as to how much you earn and how long you work, realizing that it might not be pushing your benefit up as much as you think. So I'm going to give you all of that math, but it's really important that you understand how they work through the calculation. So let's dive into these 9 essential truths. Again, I have Tyler Williamson with us today. Welcome, Tyler. Excited to have you.
Thank you for having me back.
So Tyler is our Social Security expert. He does 50-plus presentations a year talking all about this. It does seem like most of your conversations are on how to actually receive benefits, how to file, like the filing strategy, the spousal, the survivor benefits. So we're going to hit that in the next couple episodes. I'm going to dive right into how it's calculated because it's math and that's what I like.
Yes, you're amazing.
That's nice of you. But okay, here we go. So number 1, FICA tax isn't just income tax. It's 6.2% Social Security tax and 1.45% Medicare tax. So what's happening there is the government is taking money from your paycheck, and this is specifically earned income, in order to fund the trust and current beneficiaries of Social Security payments. So that's what FICA tax is. This is item number 2. Your employer doubles that. So you are paying 6.2% Social Security, 1.45% Medicare, and your employer is doing that as well on your hours, on your wages. So they have to cover it as well. It turns it into 15.3 all in. If you're self-employed, you're on both sides of that. We'll cover that here in a minute. So number 3, high earners cap out. So this number is something that we track. Tyler, you've seen this and talk about this. You keep this thing memorized. It's $176,100 in 2025.
Yeah, exactly. So for anyone who's earning over that amount, they stop paying the Social Security side of that. Medicare is going to follow them all the way through, the 1.45, but the 6.2% for both the employee and the employer, that stops for every dollar over that $176,000.
So if you make high income, you might not realize that your your take-home pay pops a little bit at some point once you cross this 176 line.
Yeah.
And then January rolls around and it drops again because you've reintroduced Social Security tax.
Yeah, and you know, this is why someone who's been making on average maybe this higher income amount throughout their entire life will have the same Social Security benefit as a multimillionaire, right? Because they're both paying the same amount of tax on that first 176. So there is a maximum Social Security benefit regardless of how much money you've made over your lifetime.
Yeah, if you've maxed it out every year that you were eligible, you'll hit that max, which we do run into, and it's pretty crazy how big those benefits can be.
Absolutely.
Okay, and we'll talk about how that gets calculated here in a sec. Number 4. The money doesn't go into your account. Sometimes people think like, okay, I'm putting my 6.2% aside and then I get to take that part back out when I retire. It's like, no, that's going in and then that's flushing out right away to retirees.
Are you saying that my current FICA tax that I'm paying is paying for a current retiree?
Exactly.
They're not putting it aside in an account in my name that I can draw upon in the future?
Exactly. And if you could, you would probably outperform the Social Security benefit. Like if you could take this 6.2% and put it into an account and grow it every year, you would probably outperform what you're going to get in Social Security.
I think you're right. Yeah, wouldn't that be incredible if we could opt out?
Well, there are companies that they can. They are government-related entities. So if that's you, that's something to know, especially because there used to be a penalty on that, and now there isn't. So anyway, something to talk about, not for today.
Yeah.
Okay, so the money doesn't go into your account. It pays current retirees. Number 5, you only need 10 years to qualify for Social Security benefits, and specifically that's 40 quarters. So you go to your Social Security earnings history, and it'll show the eligible wages for every single year, and you need 40 quarters. So my wife worked for 8 years before we had our twins, and then she was staying at home because life got crazy. And so now, in order for her to get her own benefit, now she could take a spousal benefit off of mine, which we'll talk about later, but in order for her to get her own benefit, she would need to work for 8 more quarters. She'd need to work for 2 more years to qualify under her own benefit. Now, even with that, her own benefit is probably going to be less than the half of mine that she could take. So we wouldn't have her work for that reason. It would be more if she wants to, and it makes sense from a life standpoint. That's right. Anything to add on these 40 quarters?
They don't need to be consecutive, right? So we see a lot of times where someone who maybe worked early on in their lifetime, stepped away from the workforce for some reason, and then came back later and worked a few years and was able to get those final few quarters to be eligible for benefits. So the recency doesn't matter.
Right.
The consecutiveness, it doesn't matter. Just they need to pay taxes on 40 quarters or 10 years of earnings.
Worth of earnings. Okay, number 6. This is benefits are based on your top 35 years of earnings. So even though you only need 10 years to qualify, you would be including a whole bunch of zeros if you only had 10 years of earnings, because they're going to include your top 35 years worth of earnings. What we find is that some people have a career that lasts 35 years, and if they worked 36, 37, 38, the smallest of those years, the years in which they earned the least amount, they just disappear.
Right.
And even though you paid FICA tax on that, it's a little bit disheartening because you paid taxes that are having zero impact on your Social Security
did you know
benefit.
good?
Right. Now, if you've only worked for 20 years, then you've got 15 zeros in there. So each year you work a little bit can have a pretty meaningful impact on the benefit.
Absolutely.
Okay, here is the other one, that number 7, which is earnings are inflation adjusted, which makes old years surprisingly valuable. We find that a lot of people think, oh man, 40 years ago, I mean, I've worked for forever, but 40 years ago, I only earned $20,000 or $25,000, or maybe it's 20 years ago, I earned $45,000. So I've got 4 examples here. Let's say someone in the year 23 earned $85,000. This is somebody who would turn 62 in 2025. This table has. There's something called inflation factors, and I have the link, so wherever Tony can put it on the screen, it'll be on the screen or in the description, where you can click on a link to ssa.gov, which will show you how you can get your inflation factors if you really want to. It's a little bit of a nerdy thing to do if you're going to do it, but we can get you that. And it goes back and it says, okay, for every dollar you earned, in this case, for every dollar you earned in the year 2000, you get $2.07 worth of value as of right now. So they are adjusting old years to basically bring them to today's dollars. So an example would be someone who earned $85,000 in 2023, but back 23 years ago in 2000, they earned 45. They might be thinking, gosh, 85, that's a lot bigger than 45. That 85 year really helped my benefit way more than 45 does. That's not true, because 45,000 multiplied by a factor of 2.07 turns into $93,235.82. So $93,000 in the calculation is what you get for that 45,000 earned in 2000.
That is so encouraging, because I think about my days when I was mowing lawns, Zach, and I was making maybe $2,000 a year. You're telling me that could be worth $4,000 today to me.
Probably.
Maybe even 5.
I still keep my W-2 from Lagoon Amusement Services. I worked at a Lagoon. It's called an amusement park here, but it's called Lagoon. And I made $1,000 the entire year, working well below minimum wage. I don't know how that worked exactly. I think I was underage. But the bottom line is that's not helping me at all. That was so low. The factors are not helping. But it's helpful to know, like if somebody earned $30,000 back in 1990, that's a long time ago. Sometimes people's career do span that long. That would get a 3.17 factor. So $30,000 in 1990 is worth $95,000. So just keep in mind, they're going to normalize every year's worth of income to figure it out in terms of today's dollars.
Yeah, and I also like to point out in these presentations that it has nothing to do with recency, right? One question that I often get is, well, what happens if I step to part-time the last 5 years of my working career? Will it affect your benefit? Maybe, because it may not be one of your highest 35, but it has nothing to do with recency. They just look at your highest 35 years adjusted for inflation, and those are the years they're going to use to calculate your benefit.
Right. Okay. So they get the inflation adjusted amounts. So we're in item number 7. Earnings are inflation adjusted, which makes old years surprisingly valuable. Let's move on to how they figure out something called averaged indexed monthly earnings. That's an acronym we didn't cover last time.
Oh, it is. We forgot about that.
AIME. So AIME, average indexed monthly earnings. What they do is they say, okay, this year was worth 95K. This year was worth 93. This year was worth 85. Let's add up all 35 years. There might be some zeros in there, and we'll divide it by the number of months worked and get you to an average indexed monthly earnings, AIME. They take your AIME and they apply it. They give you different percentages of different sections of it. So this is number 8. That Social Security applies bend points, and they give you 90% of the first section, 32% of the next section, 15% of the third section, and 0 after a certain threshold, which you covered already in previous episode that above 176,000, you're not getting any more benefit. You're not getting any more tax, but you're also not getting any more benefit. So they apply bend points. So we'll put something up here so you can see. But you start with the AIME, that average indexed monthly earnings amount, and the first $1,226. So this is in 2025. These numbers change every single year. So it used to be under $1,000, and now it's $1,200. It's going to go up in the future. So for that first $1,226, they're going to give you 90% credit on that. And they're doing this because they're wanting low-income people to have as much of a benefit as possible. Then from 1,227 up to 7,391, they're giving you 32%. So you're getting 90% of the first section, but you're only getting a third of the next section. You're paying the same 6.2% tax on both sections. So you're getting less bang for your buck on this next section. And then the third section is above 7,391. You're only getting 15% back. So I've had people that are thinking they're doing themselves like a huge service by, like a self-employed person, by paying themselves from, like increasing their income that they pay themselves from 150 up to the 176. And I'm like, why? There's $26,000. You're going to pay 6.2% FICA tax on it for Social Security. And they're only going to give you 15% of the increase. And the increase is going into a 35-year average.
Yeah.
It's really not going to help. I mean, a couple dollars a month, and you're going to pay thousands to get it. It's not worth it. So depending on where you're at on that scale, now, if you had a bunch of zeros in the calculation, maybe, but you're getting a lot bigger bang for your buck on the first bend point.
Yeah.
So we can do a little bit of a chart here as well where it shows you, like, depending on your annual income, how that would work out. But let's convert these numbers into annual numbers. So basically, on an annual basis, if your average income works out to be $14,700 or less, on that section, you're getting 90%. Up 88 from 14,700 up to 88,700, that's where you get the 32%, and then up to the 176,100 max, 15%. So this is where, like, if you're self-employed, there's some strategy. I'll talk a little bit about that here in a second. But that bend point understanding is so important. People don't understand that you're getting more for that 6.2%. on the early dollars you earn than you are, and you're paying the same 6.2% on the later dollars you earn.
And Social Security was always designed to help those individuals who are maybe lower income, right?
Right.
Replace a higher percentage. And I think you said that, but it's important to remember that for those lower wage earners, it is going to replace a higher percentage of your overall income.
Right. One, because they make less, but two, because they're getting that 90% and 32%, whereas a high wage earner is they're also getting that 90 and 32 on those sections, but a big chunk is at 15 and 0 for them. Okay, number 9, self-employed individuals are hit hard because they pay both halves. They're paying 15.3% instead of 6.2 and 1.45. They're doubling that, paying the employer side of FICA tax. But they also have more flexibility. So especially if you are an S Corp. So we're getting into a little bit of detail here on businesses, but business owners will understand what we're talking about here. That you can choose, like let's say someone makes $400,000. They can justify that a reasonable salary for their job is $80,000 a year. They can split that income apart and say, $80,000 is my wage. It's what I earn from my job because that's a reasonable salary for my job. And the other $320,000 is just because I'm an owner. And because you're an owner is not like actual work. You just happen to own the thing. It's like an investment in that way. So you can pay FICA tax on the $80,000 and not on the other $320,000. Now you're going to have some additional filing requirements, and most of the time that involves a CPA. So you're going to have some tax filing costs. But if you do that, which a lot of people do, you should understand these bend points, because if you're self-employed, I would for sure make sure that you're getting the most out of that 90% bend point, and maybe dip into the 32% bend point if you feel like you have to, based on not getting audited or in trouble for not paying yourself enough of a wage. That's a thing too. But I don't know if I would go like gangbusters into the 15 and 0% to pay a ton of taxes, 15.3%, just to get a tiny bit back. Yeah, a tiny bit back on that last bend point.
What have you seen? Because we work with a lot of individuals that are self-employed and that do have S corps, and maybe they're in business with their spouse, right? What have you seen, and what advice have you given there, where maybe they're paying themselves as a couple $100,000 a year, and what we see sometimes is they're splitting it.
Yes.
What advice do you give there?
Okay, so it really depends on what they've already done, because oftentimes we get to meet them 2 decades later.
Yeah.
They've already made 2 decades worth of decisions.
Right.
So if we're in that scenario, I'm looking at what they've already done and what their Social Security history is, because if they're at a spot where they have paid one spouse solely, the catching up of like trying to pay the second spouse for the last 5 or 10 years to get them a Social Security benefit, it's like as a spouse, you qualify for a good chunk of your primary earner's amount anyway. You're going to pay a lot of FICA tax for nothing.
Exactly.
So if in most scenarios, I'm actually, okay, let's just take from a Social Security standpoint alone, there are times when it's a mistake that people understand it wrong, and they think, well, I got to pay my wife some, even though she's not super involved in the business, or I got to pay my husband because he's not super involved in the business. They think they have to do that to get that spouse a Social Security benefit.
To get the credits, right? The 40 quarters that we talked about.
Exactly. And it's like they don't even need it.
Yeah.
All they need is to be married to you still.
Yeah.
Or actually,
and
you don't
sometimes
even
divorced.
have to. I forgot. Yeah, you don't even have to. You could die or be divorced, and they can still get a benefit off of your record.
Just make sure that you stay in that relationship for at least a decade.
We are not giving marriage advice. And if you're in a bad marriage, do not stick it out for Social Security. But either way, we're not giving marriage advice. But the point is, most cases with self-employed people, I mean, I'd have to see the math. And so I don't want to say like anything absolute. And we're not talking about anybody's individual situation here, but it's a good question. In many cases, it doesn't make sense to pay a bunch of taxes for a spouse that's going to get a benefit just because they're married to you.
Well, and this is a good point, that Social Security is not a one-size-fits-all. Right. And I would say, and I think you would agree with me, that there's a lot of tax professionals out there that miss this point, that aren't thinking ahead in terms of Social Security. And so that tax professional might say, well, let's just split the income, right, between the two of you, when that may not be the right choice. And it might be, but that's where we as professionals within the financial advisory space and specifically in Social Security can step in and analyze that situation and really make sure that you're paying yourselves like you should be.
Right. For example, it depends on how much. Let me give you a quick example. If you are going to pay a collective of $100,000, let's call it $110,000 of income to the spouses.
Yep.
There could be a lot of benefit in paying one person $15,000 a year and the other person $90,000 a year, about 95, because you're optimizing those bend points.
So one spouse is filling up the
90%.
the 90 and the 32.
Exactly.
And the other spouse is not filling up the 90, but a lot of it, right?
But yeah, 90 is 14,000.
I guess 14,000, yeah, so they're filling it up.
You fill up the 90.
Yeah.
That would be one strategy. And then I would want to mathematically look at that against the idea of just paying all 110 to one spouse. And what is the survivor and spousal benefit associated with that?
Yeah.
The only reason you might do both is because if one person passes away, you actually have the ability to go on one spouse. Like she could go on her own benefit
first
for a while and then hop on his. We'll talk about that in,
Yep.
I think, episode 3 or 4. So that would be the most I would split it. But it would not be ideal to split them evenly at 100 or 55
each. Yeah.
You'd be paying too much in tax for the maximum benefits you could get.
Agreed.
Out. That's it. Okay, so moving on to our next episode. So these are the factors that impact the calculation for wages and for earners. But we're going to flip the script a bit here, and we're going to say, okay, what affects your calculation for a retiree taking benefits out, and how you choose to do that. I feel like this is really going to be your specialty, where we hit, like, this is how Tyler advises and teaches and educates everyone around the different filing strategies. So we'll get into that, and then, of course, hit all these other topics of spousal and survivor and break even and everything else that comes after.
We're getting into the good stuff. Yeah.
The math wasn't the good stuff for you?
Not for me. For you, yes.
There we go. Thank you for watching, of course, educational in nature. As always, this is Capita Financial Network's education channel, the Zacc Call Money Education channel. You can find more on capitafinancialnetwork.com. You can find more on YouTube by just looking up Zacc Call Money Education. And, like and subscribe, follow us along. You're going to get so good with your money if you can just conceptualize these topics as we go. You don't have to understand them perfectly. You need to understand them conceptually. And then, of course, we'd be happy to help if you want us to look into your exact situation. Reach out to us at connect@capitamail.com, or you can find us on our website.